Join me in welcoming Peter Schiff.
So it said, I looked at the topic, it said Schiff speaks on finance. And I don't know if people want to hear me talk about finance, but I figure that I might as well talk about the state of the U.S. economy and kind of where we are right now in the grand scheme of things. You know, I believe that the beginning of the end was 2008. I mean, I don't think 2008 was the crisis. I think that was kind of the overture to this opera. And, so we got a lot more to go. A lot of people think that that was the end of it, and it really was the beginning. But it's interesting, if you go back to my first book that I wrote, Crash Proof, How to Profit from the Coming Economic Collapse, that book came out in February of 2007. And the financial crisis hit, in mid-2008. And a lot of people assumed that that crisis was the crash that my book was referring to. It wasn't. What my book was about the crash that was going to result from the monetary policy that the government was going to pursue in the aftermath of the financial crisis. I didn't know that it was going to hit in 2008. I just knew that it was coming. See, I wrote that the Federal Reserve had inflated a housing bubble, that by slashing interest rates to 1% and leaving them there for a while and then slowly raising them, they had enabled massive amounts of credit to flood into the real estate market, and it resulted in incredible speculation in real estate, residential real estate, by Americans. And I said that when that bubble burst, real estate prices would collapse. I predicted a 30% decline in home prices nationwide. And I said that that collapse would be enough to cause a lot of financial institutions to go under, to fail. Particularly, I said Fannie Mae and Freddie Mac would go bankrupt. And I wrote that since real estate wealth and home equity extractions had really been the basis for the consumption that had been driving GDP, that when real estate prices collapsed and real estate credit dried up, that we would have the worst recession since the Great Depression. I wrote that we would have double-digit unemployment, that the budget deficits would exceed $1 trillion a year. At the time they were $200 billion. And that we would have this horrible, the worst, environment since the Depression. And then I wrote that in response to this, the government was going to try to reflate the bubbles. They were going to try to prop up real estate prices. They were going to try to prop up stock prices by printing even more money than they did before, by lowering interest rates even lower than they did before. Right? I didn't call it quantitative easing because I never even heard that term. I didn't even know what it was. I just knew what they were going to do. I didn't know what they were going to call it. But I said they were going to do this, right? And then, as a result of all the money that they were going to have to print to reflate these bubbles and prop this economy up one more time, the dollar was going to collapse. And when the dollar collapsed, that was the crash that was going to happen. Because then I said the government is either going to have to allow the dollar to completely collapse and we would have hyperinflation, or they're going to have to dramatically increase interest rates and implode everything. Right? Because if they increase interest rates, all the banks they bailed out would fail. And the real estate market would collapse, the stock market would collapse. So that was the event that I was writing for. I was thinking the whole thing out from beginning to end. And where we are now is we're between the crash and the government, printing all this money and reflating the bubbles. Now, when I wrote my book, though, I didn't put a timetable. I didn't say, okay, we're going to have this crash, and then 2 years later, 5 years later, the dollar's going to collapse as a result of government policy. I had no idea how long it was going to take. But I didn't think it would take this long. I didn't have in my mind what the lag would be between the response to the financial crisis and the collapse that would result. Because I wrote that the economy could survive. What I was predicting, the bursting of the housing bubble, the financial crisis, I said we could survive that disease. I said what's going to kill us is the government's cure. And I believe that I'm right. In fact, they've actually succeeded even beyond my expectations of what they would be able to do. They have managed to reflate this bubble much bigger. I thought they were going to fail. I didn't think that they would get the stock market all the way up to new highs or the real estate market I thought they were going to try, but I thought the bottom would have dropped out of the dollar before that, and that would have forced up interest rates. Instead, they succeeded. And one of the reasons was, for a while, people became more concerned about Europe. They became more concerned about China or Japan. And as a result, money was flowing into the dollar. And that bought us some time. Because instead of the dollar going straight down, what did it do? It rose. See, when the financial crisis hit in 2008, the dollar was at an all-time record low. The dollar had been falling for 6 years. And it was the lowest it's ever been. And then the financial crisis hit. And the knee-jerk reaction was everybody bought the dollar. Everybody unwound their trades and they looked to buy dollars. And we had this spike in the dollar. Gold sold off. Gold went from 1,000, which was an all-time record high. Right? Gold went to an all-time record high. It was below 300 in 2001. And it rose to 1,000 in 2008. But then when the financial crisis hit, gold went down to about 700. Because people didn't really know what to make of it. They didn't know what was going to happen. And they just bought the dollar. And then when the Fed revealed its playbook, what it was going to do, we're going to print all this money, we're doing quantitative easing, they slashed rates to zero, the dollar started to give up its gains. It didn't make a new low, though, but gold made a new high. Gold ran up to $1,900 an ounce because initially people got a look at what the government was going to do, and they did the right thing. They bought gold, they sold the dollar, because what the Fed was doing was extremely bearish for the dollar. But then all of a sudden, people, began to get the idea that this was going to work, right? That the Fed, it was a success. And a lot of this was the Federal Reserve claiming it was a success. But when they started talking about ending quantitative easing, we're going to taper off QE3, and we're going to raise rates, all of a sudden people started giving the Fed credit for success, as if the policy had been a success because they had said that they were going to unwind it, even though they hadn't actually done it. But the Fed talked about how they're going to take away all the liquidity, they're going to raise rates back to normal, they're going to shrink their balance sheet. And all of a sudden, people started to discount that into the market, and people started buying the dollar, although the dollar's low. And one of the reasons that the dollar didn't make a new low relative to other currencies, even though gold made a new high, was because other foreign central banks, out of sheer panic, when they saw the dollar falling, they just started printing their own money to buy up dollars, because they didn't want their currency to be too strong, which was a mistake, and it's a foolish theory that you need to have a weak currency. But if you remember back then, they were referring to it as a currency war, because all these different countries were battling to weaken their own currency, right? So, and the difference between a currency war and a normal war is, in a normal war, you want to kill the enemy. In a currency war, you want to kill yourself. And somehow, weakness was considered strength. So you had all these governments trying to undermine their own currency. That actually put a floor under the dollar, because you had all these foreign central banks buying up dollars. But then the dollar's bull market took a life of its own once you had this consensus of opinion that everything was great and the Fed was going to start raising rates. So the currency traders started pricing in those higher rates into the dollar, and you had this big rally in the dollar in 2014, 2015, and the dollar didn't go back as high as it was in 2000. I mean, the dollar index got to 120 in 2000. It peaked out last year, or early this year in January, at just under 104, 103 and change. But now the dollar has started its fall. When the year began, there was pretty much unanimous consensus that the dollar had no place to go but up. Everybody on Wall Street was long the dollar. It was the most crowded trade on Wall Street. And so far it's blown up, right? The dollar index has been falling all year. It's off better than 10% from its high in January. It's off to its potentially worst year since 1985, which was the year of the Plaza Accord, and that began a 10-year dollar bear market. I think this is going to be the mother of all dollar bear markets. This is the dollar bear market that I envisioned when I wrote Crash Proof in 2005, 2006, except it's going to be even worse, because the dollar is falling from a much higher level than I expected, and because it's taken so long, right? The financial crisis was in 2008, and this is, almost 10 years later. The problems are much bigger. The bubble is much bigger. Instead of the dollar crashing 5, 6, 7 years ago, which would have forced a restructuring of the U.S. economy, it would have put a brake on speculation and consumption. It would have caused the trade deficits to come down. We would have had to do something about restructuring our economy, moving more towards production and manufacturing and less from, just services and consumption. But none of that stuff happened. The market forces never corrected the imbalances. They just got bigger and bigger because we were able to go deeper into debt because the dollar went up. And because the dollar went up, the Fed was able to keep interest rates at zero for as long as they were. So we just put so much more air into this bubble, because if you go back to the financial crisis and the housing bubble and think, what caused that bubble? 1% interest rates for like a year and a half. And then the Fed took another year and a half to get them back up to 5. But that was enough to give us the 2008 financial crisis. You can only imagine how much more screwed up the economy is today after 8 years of 0% rates, after 3 rounds of quantitative easing, when you have the Federal Reserve with a $4.5 trillion balance sheet. And in fact, the Fed met just this week, and they came out on Wednesday, and they finally said, we have a plan to shrink this balance sheet. And this has been all part of the bluff all along, that they're going to shrink this balance sheet. In fact, if you go back to day one, when Ben Bernanke first launched QE1, and they brought him in front of Congress, and some congressmen were saying, hey, this is money printing, this is debt monetization, this is like, we're like a banana republic. And Ben Bernanke said, no, we're not monetizing the debt. We're just buying these bonds temporarily. We're going to sell them after the crisis is over. That was the first lie, because they've never sold a single bond. Not only have they not sold a bond, they've reinvested every penny they've earned in interest on those bonds. But they've consistently been lying to the markets about their intention or their ability to shrink their balance sheet. And now they're kind of getting at the point where now they've got a plan where, okay, we're going to start doing $10 trillion a month. But meanwhile, they never actually raised interest rates anywhere near as high as the markets were forecasting a few years ago. I mean, they barely raised them. And now we're at 1.25%, 1 to 1.25. They're saying they might do it again in December. Maybe we'd get to 1.25, 1.5, but that's still nowhere near the 5% that we started from. Right? So the Fed has not been able to normalize interest rates, and they're not going to be able to shrink their balance sheet. I mean, they may be able to get off a few trivial reductions if they can. But I think where the crisis is now going to come is when we get into the next recession. Now, I think in reality, I don't think the economy ever recovered. I think we've been in one big recession the entire time. And I think that is the main reason that Donald Trump is president, is because a lot of people voted for him out of frustration over the economy. I mean, if the economy was as good as Barack Obama claimed, if it was as good as Janet Yellen claimed, then I think Hillary Clinton would have been president, because she was running on a continuation of the current administration. Well, people wouldn't want more of the same if what they got wasn't good. And in fact, if you look at the statistics of this so-called recovery, it looks worse than most recessions. In fact, it's probably the only recovery in history where people are worse off, now than they were when it began. So it's really a statistical recovery, and part of it has to do with the way that we calculate GDP and the way that we calculate the deflator. And of course, the government comes up with a methodology. The politicians want voters to believe the economy is growing, so they concoct a way to measure the economy that makes it look like it's getting bigger, even if it's in fact getting smaller. And that's what's been happening. And meanwhile, the jobs, where are the jobs coming from? They're coming from people taking second and third jobs. That's where all the job creation was. People are moonlighting. They have multiple jobs. They used to have one full-time job. Now they've hobbled together 3 low-paying part-time jobs. And, they take credit for all the extra jobs. Because if I have 3 jobs, that counts 3 times, right? It doesn't count as one job. So that's where the job creation is coming from. And the low unemployment rate comes from people just leaving the labor force, right? Oh, I give up. I can't find a job. Okay, well, now you're no longer unemployed. So they're able to get the unemployment rate down because the labor force participation has collapsed. And it's not older people, right? Janet Yellen likes to claim that the reason that the labor force participation rate is down is because the baby boom is retiring. Well, the problem is the baby boom is too broke to retire. They're still working. It's their grandkids that are not in the labor force. It's the 20-year-olds. You have record high. People in their 70s and 80s have never been employed in as high a percentage as they are today. It's people in their 20s and their 30s where their labor force participation is an all-time record low. So this hasn't been a real recovery, but now we're about to start an official recession. Now, I don't know how many quarters away it is. I've been surprised. I mean, you look at what's happening in the retail sector. They're calling it now, it's a retail apocalypse. I mean, these stores are blowing up. It's actually worse for retail now than it was in 2009 in the Great Recession. In fact, Toys R Us just declared bankruptcy this week, second largest bankruptcy in U.S. history. And, of course, a lot of people want to shrug this off and say, oh, it's all because of Amazon. It's not all because of Amazon. Amazon was around in 2009, 2010, 2011. There's something else that's going on. It's mainly because their customers are broke. That is the problem. People don't have the money. In fact, they haven't had the money for a long time. They've been buying on credit, and now the credit is running out. And so all these retailers are imploding because their customers are broke. They're underemployed, they're unemployed, they're loaded up with debt. Look at credit card debt as a record high, student loans at a record high, auto debt at a record high. Right? The only thing that isn't at a record high is mortgage debt, and that's because home ownership is at a 60-year low. You can't have a mortgage if you don't have a house. Right? But if you look at people who still have houses and mortgages, their debt is off the charts. So households are in much worse shape than they were in 2008. The government, the federal government, is in much worse shape. We got over $20 trillion national debt. When we went into the financial crisis of 2008, it was less than $10 trillion. And, of course, it's now all financed with T-bills. We have a giant adjustable rate mortgage on the national debt. So, and this so-called recovery, even though it's been the weakest recovery ever, it's required the most amount of stimulus to produce it, and it's now one of the longest recoveries ever. There is pretty much no chance that we're going to get through the next several years without another recession. Well, the problem is, when this recession hits, where are interest rates going to be? 1.25%, 1.5%? That doesn't give the Fed a lot of room to slash rates to stimulate. And, of course, the artificial stimulus that governments give, I mean, it doesn't really help the economy. Right? It's like taking drugs and getting high. And the other similarities are, as you build up a tolerance, right, you need a bigger and bigger dose. So in order to reflate this bubble when it pops, the government is going to have to use a bigger dose of stimulus than they did last time. So the next round of quantitative easing is going to have to be even bigger than the first three. Right? So because they're going to have to start cutting rates. They can't go from 5 because they're only at 1.25. So they have to fight this next recession. They're going to cut rates from to 0, and then they're going to have to launch another round of quantitative easing. Meanwhile, right, what is the Trump administration going to do? They're going to pass some type of tax cut. I only have 3 minutes. Okay, they're going to pass some type of tax cut. It's not going to be tax reform. It's just going to be tax cuts. They're going to increase spending on the infrastructure. They're going to increase spending on the military. They're going to increase spending on the border. They're going to have massive aid for hurricanes, not just the one we just had in Puerto Rico, but we had the one in Florida, we have the one in Texas. So you're talking about hundreds of extra billions of dollars for bailout money for disaster relief. Meanwhile, they're about to get rid of the debt ceiling probably in this next budget bill. So the deficits are going to skyrocket, right? Well above the trillion two that we had under Obama. And now the dollar is already falling when everybody believes that the Fed's going to tighten, that the Fed's going to shrink its balance sheet, the equivalent of quantitative tightening, and there's no more flight to safety in the dollar. Every time North Korea fires a missile, they buy the Swiss franc, they buy the yen. The dollar is no longer the go-to currency, the safe haven currency, and believe me, there's not going to be currency World War II. Big countries, Russia, Saudis, China, everybody's trying to figure out how to get away from the dollar, right? So when all of a sudden the whole view, everybody is over here in what they believe, and they're going to all try to rush over here. All of a sudden, because now, wait a minute, the Fed's not going to keep raising rates. They're going back to 0. They're not going to shrink their balance sheet. It's going to 10 trillion. We're doing QE4, right? The bottom's going to drop out. And then what's going to happen to consumer prices in the United States? All this inflation that we've been exporting all these years is going to come back. It's going to hit us like a tsunami. All this paper money is going to come back. Prices are going to start to skyrocket. And what is the Fed going to do to contain the inflation? Nothing. Because they can't do anything, because they're powerless. Because if they raise interest rates to fight the inflation, then they collapse the stock market, the banking system. The U.S. government has to default on its debt, because the only way we can pay our debt is if interest rates stay low. In fact, we're not even paying it. We're just paying the interest. But if interest rates go up to fight inflation, the government can't even afford to pay that. So we would have a much worse crisis. That is what I was writing about when I wrote my book. But now it's an even bigger problem, because the choices are more difficult, because it's more extreme. Either the inflation is worse or the collapse is worse. So I think what people need to do now, to the extent that they haven't done it, is to get prepared for this crisis, to get prepared for the dollar collapse. And, I've been doing it with, my clients. I invest in a lot of stocks around the world. I buy stocks in Singapore and Switzerland and Hong Kong and in Norway, places that I think are relative safe havens. I try to buy quality companies that pay good dividends. And then, of course, I buy gold and gold mining assets, and we're about to talk about that in the next panel. So I guess that's a good transition. Thank you.
Thank you. Peter, while you're still here, I want to thank you very much for what you've done. You have helped me personally and many others with the advice you've given. It's scary sometimes, but it's good, and we really appreciate it. Thank you. Thank you. Ladies and gentlemen, Peter Schiff.